Hello traders and investors, Tyson Clayton here, Market Traders Institute. I want to talk about something very important that happens in the market. Doesn't happen a lot, but when it does, we need to pay attention, and that's gap trading. It's gaps. How are gaps created? Essentially, they're created when imbalances of buyers and sellers happen. I'll give you an example real fast in the stock market, right? Let's say a stock is reporting earnings tonight after the bell. Right? The stock comes out and it's supposed to report $1 worth of earnings, but it only reports, let's say, 50 cents. When that happens, it's going to shock the market, and the market's most likely tomorrow going to gap down because now the expectations were they were going to come out with really good earnings. They came out at 50 cents, so the market is going to anticipate the market to fall. There's going to be less buyers at that current level, and that's when gaps form. Now, there's ways to trade gaps, and there's different strategies we can use. There's times to look for a continued move in the direction of the gap, and there's times to look for a reversal. I'm going to show you an example of that right now. There's a continuation gap move that we want to look for, and it happens when the market is in a range bound, right? When it's moving between levels of, let's say, support and resistance, highs and lows, and it's moving in this kind of channeling. When that's happening and price then, let's say, gaps from this upside channel and it gaps down, what we can look for is we can look for price to have a move that continues down to that level of support. Then what we can do as traders is we can look to buy at this level of support here back up to the gap. But we want to make sure that we trade in the direction of the gap if we're looking for a move down to the support. That's a continuation move. Right? There's also what's called a reversal move. It's important to understand when you should trade in the direction of the gap or when you should trade against it. The reversal move happens when price is sitting at an extreme level. What I mean by an extreme level is a multi-week or multi-month or maybe even a multi-year high or low. When that happens and price then gaps in the direction of the major trend, that's typically a sign of exhaustion. Right? It's typically a sign that the buyers are getting kind of exhausted and that they're most likely ready to reverse the market. So what we want to do in this scenario is we want to look for those gaps in the direction of the overall trend and then look for those reversal patterns such as crowning patterns to trade that back down and fill the gap. But we got to know when to do that, why to do that, and also are we going to get a continuation or are we going to look to trade that back to the gap fill? Now, there's a pattern that I love to look for, and I love this. When I can find this, I absolutely start to get really excited. It's called an island reversal, okay? Real fast on this, what we're looking for is we're looking for a gap after price has moved to an extreme level, a gap up, then some type of reversal pattern, and then a gap down. And what happens is it forms a little bit of an island right there. Price is kind of by itself. And this is a very high probability area here that professional traders can start to look back to trade back to fill that gap. It's an absolute brilliant strategy, and it's one of the strategies we teach in our live trading sessions. I'd love for you to click on the link below, sign up for one of those free live trading sessions. And hey, if you're watching on YouTube, make sure you subscribe to our channel. You'll get updates on cryptocurrencies, on the Forex world, on stocks, all of that stuff. We'll see you in the trading room.